Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. I think we are live. Yes, we are. Great to be here with you on this Saturday afternoon. Certainly exciting things happening in the silver market, and reported last night how we saw an increase in lease rates. On the line to dig into that today is David Jensen. Although, real quick before we welcome David in, today's video is brought to you by one of my favorite silver companies, which is Dolly, Varden Silver, run by Shawn Khunkhun, who's taken over about a year ago. One of the most impressive folks I've met, and I don't know, you can think what you want. I'm not, that's how I feel about Shawn, regardless of even before he was a sponsor. I love the way he handles things. And if you'd like to find out more, that can be at dollyvardensilver.com. Also, Shawn's been on the show a couple times. Here he was explaining, he's been doing junior mining stocks for I think 2 decades. So if you're looking for those ones that could be a 10 bagger or more in a rally, well, that's on the page. And thanks again to Dolly Varden Silver for bringing us this call today, because while you cannot see him, David Jensen is on the line, the at real David Jensen, Jensen on Twitter. So David, thanks so much for joining me on a Saturday. How are you today?
I'm well, Chris. Good afternoon. Good morning from the coast, I guess, but good afternoon where you are.
Yeah, well, it's nice and sunny here in Texas.
Oh, Texas, okay.
Storm gone. It's like as if it never happened. Although something that is still quite there, and that fortunately you reported on last night, which I will pull up on the screen so that people can see, because you had a tweet saying silver shortage starts to show in London, silver markets with initial surge in silver lease rate. Not the easiest data to come by, so perhaps you could dig in, although maybe you can start with explaining for anyone new what exactly is a silver lease rate and why would anybody lease silver?
Yeah, sure. In simple terms, the lease rate reflects the cost to borrow silver in the London market, which is the world's dominant and largest physical silver market. And as you can see there, there's both negative and positive numbers. And the reason that you have the negative numbers, especially for something like silver, is because there's a cost to store it and there's a cost to insure it. And as a consequence, those who hold large amounts of silver, it takes up a lot of vault space, are happy to let it go out into the market, and they actually pay you. That the negative rates reflect the fact that you actually get paid if you take the silver off of their hands.
So,
So
David, again,
yeah,
and I'm going to try not to interrupt your flow, but at times, just to make sure some of these things are clear, because especially for the people that it's new, I may just ask you to repeat a couple things. So, you're saying that people with large stacks of silver will actually pay someone else to hold it at certain points in time, just because then they don't have to take care of that expense. Is that phrasing it correctly?
that's correct. So that's a per annum rate. And you can see there that, silver leases are technically payable in metal. So if you borrowed, let's say, 1,000 ounces and held it for a full year, you would have to return 1,000 ounces less, a split of 1% there. So, in some cases, it's like 0.5%. So you'd pay less bars back and less ounces back if you borrowed it for a full year. So and then when it goes positive, that means that not only do you, as the borrower of the metal, and people borrow for a variety of reasons. If the offer is if there's no metal offered in size, you're forced out of the market and you turn to other sources. If you owe the metal, banks may owe the metal, or industrial users may need the metal. And they think, well, I can borrow the metal for a period here in the market in adequate size, because the offer, there may not be enough ounces on offer in the market. So when it goes positive, not only do you have to pay for the storage of the metal and for the insurance of the metal, you also have to pay the metal back at a later date with an interest rate payable in metal as well. So you have to pay back more ounces than you borrowed. And when you get into difficulty with this is when you're in a squeeze situation and the price starts to spike. You have to re-enter the market at a later date to buy the metal back at a higher price. And you have to buy additional metal back to repay the lease cost as well. So you get hit twice with an accelerated or an increased price point in the metals market. So the tightness that we're starting to see here, the other interesting thing, Chris, is it's across the three tenors that are shown here, 1, 3, and 12 month. It's all three of them are moving together. Oftentimes you see you'll see the near end month, like the 1 month, move a little bit slower than the longer month lease rates, but they're all moving together here. So we'll keep tracking this in the weeks ahead, but it looks to me like it's showing the initiation or the onset of a tight market in London, which is the predominant market. I don't follow the COMEX because of all the outs that are there in terms of the rule book that allows the directors to force cash settlements and other things. That I think it's mostly a digital show there. I mean, there is metal that moves through, but we've been hearing people for 15, 20 years saying, this is the month where they're going to have to settle and they're going to squeeze and take all the metal off the COMEX. But I just personally don't think you'll see it until the very end of a run. And I think you'll see it here in London much, much sooner because this is an active physical market.
Well, that makes a lot of sense, David. And that was actually one of my questions I was just writing down. So we'll go with that one next, where I agree with what you're saying that it would make sense to see it in the lease rates first. Although given that we have such escalated premiums on physical silver above the COMEX price, at least as far as I can see, there's an economic incentive for people to take delivery of the COMEX. Now, I've been asking so far, given that exists, why have we not seen it? The only answer I've heard so far is that the COMEX makes it difficult to get the metal, which I don't dispute. But what is that the only reason, or why? Otherwise, why are we going to see people take delivery on the COMEX? This was the same dynamic we saw last March when COVID hit. And by the time silver got down to $12, I mean, it shot back up pretty quickly. And then again, later in July. So what do you think about that?
Well, I think you're dealing often with bullion bank intermediaries, and you have to take what the bullion banks offer you. And so, what they've been asking for is premia, and they've been asking for delay in terms of getting the 1,000-ounce bars out of the COMEX. So, so you're being throttled there. And as far as the retail investor demand, you're going through a choke point there in terms of what the refineries can produce in terms of the retail products, bars and coins, etc. So, I think the key here is if you want just the raw hard data, they're saying that 1,000-ounce bars in London, we're starting to see the lease rate rise, which is the cost to get access to actual physical metal. And when you're dealing with these unallocated contracts, even in the spot market in London and in New York, you have the futures being traded on the COMEX, the CME COMEX. Those are reflecting unbacked assets, and usually in terms of the contracts that are being traded, and you get digital noise there on a day-to-day basis. But what we're seeing here with this lease rate is what's it cost to get your hands on a bar for a period of time. And it's the best indicator that I've found so far in terms of revealing true supply and demand, unmitigated by the digital trading that goes on with these other contracts that are being traded on these exchanges.
And David, could you possibly put it in context? We see it spiked, some of the rates spiked as high as 1%. Mm-hmm. How high has it spiked before? How often does it spike? Anything along those lines? So if someone's again seeing this for the first time, can grasp really what that's saying.
I'll post a chart later on. I don't have it at my fingertips here, but we've seen the rates when there's shortage pop for a short period of time to 10%. But what we're seeing here is that the markets have been subdued and they've been asleep in terms of responding to any kind of physical signal. And all of a sudden, what I'm pointing out here is that all of a sudden we've got a breakout here of, okay, the demand showed up. It's stressing the market to get your hands on some bars, and we're starting to see the movement. So now let's watch this going forward.
And how often does this happen, though?
Not often. I mean, especially with silver, because it's such a bulky commodity. it takes up a lot of space in terms of dollar value per square foot in a vault. And as a consequence, it happens when there's stress in the market. Happens usually for short periods of time. But what I find very interesting is that basically this chart is showing us that since the end of January there, where this activity started up in the market and I really look at it as the deplorables that are buying it. I don't really see it as a bunch of Gen X people that are looking to make some money. I mean, they are definitely in there, but I think that there's a movement in general in the US, and the demand is coming from the US. We know that it's not coming from the spike in demand is not coming from other markets. So I really view this as an exit of the deplorables who I think they're tired of the corruption. They've seen it on so many different levels, including the presidential election. And I think people are exiting the system and getting hold of real assets that that have virtue and that aren't manipulated when they're in your hands the same way that they could be if they're held by a bank.
Yeah, well, as we'll get into, maybe they're watching some of the Goldman Sachs economic ideology being presented on CNBC. That'll have that effect, and I appreciate that you dug into that as well, which again we'll get to. But I guess where would you say we are if you have, I mean, we've had various forms, I think you could say, of default. I mean, those prospectus changes on the 3rd.
Mm-hmm.
So I'm wondering, like, where we are, how late in the game is this? The last line of defense, or is it, well, things could still calm down, or how close to something more overtly breaking do you see this?
Well, I mean, you can always change the rules and buy a little bit of time here and there. I think what's interesting is what Ronan Manley pointed out is that 85% of the bullion in London theoretically is spoken for by ETFs. So there's, round numbers, about 1 billion ounces. So it would leave about 150 million ounces of slack. But I'll tell you that slack, and we'll go forward here discussing Jeff Curry's comments, but there may be no slack and actually a whole lot of negative slack there if what Jeff Curry of Goldman Sachs says is correct. And that is his pointing out that the ETFs have been rehypothecating or obligating the silver that they hold for their beneficial owners, who are the shareholders. The beneficial owners own the metal that the ETFs hold. And Jeff Curry said on CNBC, as you pointed out, Chris, that the ETFs buy silver for the shareholders and then turn around and dump it back into the market again in terms of obligating it with hedging activity. So you end up with multiple, I'm just laughing at you laughing there, but you end up with multiple claims on a single asset, which is, the saying from the 20s, right? He who sells what isn't his'n must buy it back or go to prison. And I think that these guys are looking at this, and I'm flabbergasted that Curry would say it so offhandedly here in the clip that you've pulled up, but it's really quite an amazing statement.
Yeah, David, in fact, you're not the only one who's flabbergasted. I have a lawyer now who's been submitting evidence, getting this stuff on the CFTC's record. So at least if they do nothing and it implodes, then we can point to specific people who received that evidence, sat on it, and let the losses grow bigger. We'll leave that aside for now. But I think, small tangent, and we'll get back to it, I think it could be a fun episode of the show, videotaping the lawyer's face as you walk through what Jeff said here. Mm-hmm. Because it's really quite wild. Although before I play the clip, following up what you just said, do you see, am I summing it up correctly, where it seems like the only two outcomes that you or I can think of are that either Jeff gave flat out incorrect information, and given that he's chief of commodities for Goldman Sachs, which is somewhat influential in the market. I mean, we know about the shitty deals they were selling during subprime that certainly had an impact and then were depicted in The Big Short. So either he was giving out wrong information, which I think would be negligence, or if what he said was actually true, then it confirms the silver scheme is on shakier ground than we even thought. Is there another outcome, or is it one of those two?
I think that he looked frustrated in this clip, and I think he just spoke without thinking. Maybe he lives in a world where you make the rules up. I don't know, and you go along and do what you want as you go along, and it doesn't matter. But the idea that you should obligate someone's possessions, which aren't yours, into the market without notifying them or without them giving you approval, first of all, is quite shocking. And so I think it going back to the point about the obligation of the silver in London. If that billion ounces, only 15% of it is spoken for by others other than the ETFs, that doesn't leave very much wiggle room. And then if you consider the fact that reflects excess artificial supply in the market through this hedging activity of the banks who have resold or re-obligated silver into the market, silver that's not there in terms of legally there and with title to do that, then we've got now to cover, must buy it back or go to prison. We've got a ton of silver that has to be bought back now to cover those obligations, which the ETFs should not have made. So, yeah.
So, David, would you say then that, at least if what Jeff was saying, if he was being honest, that would you say it would have been immoral, or would you go as far as to say that would have been flat out illegal, given that in the iShares prospectus, there's a line that says, the trust does not hold or trade in commodity futures contracts?
Yeah, you cannot obligate someone else's owned possessions in the market without their permission.
Especially if you put that in the contract.
That you won't.
And then you change the contract, and then you said this. Actually, let me make sure I got the sound queued up there so we can hear Jeff clearly in his own words talk about a hedge that was forbidden in the prospectus. And this is an authorized participant. Might add one of the groups that can add or redeem baskets. So
silver market, and then you go on.
They just said.
But I guess my question is, forget the ETF. In terms of thinking about how you're going to create a squeeze, the shorts are the ETFs. The ETFs buy the physical, they turn around and they sell on the COMEX. Shorts are the ETFs. The ETFs buy the physical, they turn around and they sell on the COMEX to be able to hedge that physical position like any other corporate. It's not.
David, I'm confused by what he's claiming they're hedging there. I've spent a week trying to figure out any plausible way that they could be hedging people buying shares that JP Morgan is supposed to be storing as a custodian. What have you been able to come up with?
Well, a shareholder of an ETF carries the risk. So if the ETF is buying silver and holding it for the shareholder, and the shareholder is carrying the risk, there's apparently nothing for the ETF to hedge. So calling it hedging is interesting because there's no risk for the ETF to hedge if they're just straight out buying silver for the shareholders and holding it in JP Morgan's vaults for a fee. So, and when you read the prospectus, the Bank of New York Mellon are the trustees in this. It's a BlackRock sponsored ETF, but Bank of New York Mellon, it says in the custodial agreement, gives directions to JP Morgan as to what to do with the silver that JP Morgan is holding in the vault for the ETF. So, there's a lot of questions to be answered here in terms of what is really going on with the concept of hedging something which you don't own and for which you have no risk into the market. And it would be really good to hear BlackRock, Bank of New York Mellon, JP Morgan Chase, and some of the other players come out with statements on what is going on with these ETF markets to clarify the confusion that Jeff Curry has thrown into the market with his statements.
I certainly would agree with that. And expecting, I know the CFTC is investigating this matter. They, for some reason, are looking at the Reddit traders. Maybe they didn't watch CNBC, but I'm sure that they'll be on it now that they starting to find out this evidence has been documented and sent to them. But let's go back here for a second. It's kind of weird. It almost sounds like he was giving a tutorial on how to create a short squeeze, which, I mean, let's hope that's not what was happening, but
Go on.
Those
Right, but I mean, you look at the flows going in and out of these ETFs, they're not that big. But I guess my question is, forget the ETF. In terms of thinking about how are you going to create a squeeze, the shorts are the...
Actually, I'm going to go back a little earlier because...
Sorry, can I interrupt there for 1 second, Chris? Because I just want to grab that one point before I forget it. He says the flows going in and out of these ETFs is not that big. So we know from Manley's work that there's 150 million ounces available in London of bullion that's not already held, beneficially held by the ETFs themselves. And if that is the case, how can you call 110 million ounce movement or 105 million ounce movement of silver into just the SLV ETF alone in a period of a couple of days as not a material movement? I mean, they're basically gobbling up over 80% of the notionally available silver in the London market. And by the way, that 150 million ounces that remain behind, other than the 85% held by the ETFs, nobody knows if the owners of that bullion are even willing to sell. So you got 150 million ounces. What number of those ounces are the owners willing to sell? And then how does that not become a material amount when you're looking at 110 million ounces moving into an ETF and one ETF in a couple of days?
David, do you think there's any chance that's discussed in JP Morgan's recent silver report?
No.
Oh, okay. I didn't either. Although back to what you were saying here, let's put this in context, because what Jeff, is just like minuscule small inflows here. Now we had a 20 back in January, and that, knocked me off my chair. But then that first, right, the week before, you had these insignificant inflows in this 25 billion ounce market that I can't find. Then you have 34, 20, and 60. These are each single day additions. And now you can see this is the 3-month chart, or the 6-month. You see there's those spikes going back a year. I mean, there's nothing even close. There's back 2 years. I mean, to say those weren't substantial, I mean, here's as long as the chart goes back. And I see one spike in 1998. David, I would guess that would have been when Warren Buffett probably bought silver, would you imagine? Or I'm not sure what else that could be. Any idea?
Yeah, it could have been.
So aside from that, basically, plus this 61, if you added the 34 and 20, if you count that 3-day period in the history of silver, including the Hunt brothers, this was the greatest amount of silver ever added. But Jeff doesn't think it's that big. Does it seem large to you, David?
I'm just saying that if there's 150 million ounces in London that aren't already locked down by the ETFs notionally, 100 million ounces in a couple of days is mind-blowingly large.
Okay. I thought so too.
Can you give me access to my screen top? I seem to be locked up in the Zoom screen. I just want to flip you a chart here, and maybe we can touch base on that. Perfect.
You want to be able to screen share?
Yeah, or let me just pull it up first.
To go now on that.
Let me pull it up first, and then I'll screen share after that.
Perhaps while you're getting that queued up, I'll play one other thing that didn't
quite understand. I've got it now.
Ready? All
yep.
right. Cool.
So we can screen share now. So can you see my cursor moving?
I did not see your screen yet, David.
Okay, should I drop it into Zoom, or it's filling my entire screen?
Is there a link you can send me in the chat and I'll pull it up?
Yeah, there is actually. Sorry for the pause.
That's all
But
right.
I think this.
You
I
can
think
hear
this.
Nibbles in the background. He gets excited about finding banker fraud, and
Yeah.
it's been keeping us busy over here at Arcadia headquarters. It's hard to write down in the legal file as quickly as they say the stuff. So, but again, that's one of the reasons I'm really inspired by all the way the community of honest people who don't act like bankers that commit felonies and then either say nothing or then try and lie on TV. And people are standing up and digging up evidence and just responding in a positive way. So, David, I'm going to play this real quick while you're finding that.
Yep.
Because here, it was interesting. The guy interviewing him, it was almost as if, just my interpretation, having worked on Wall Street, where it was like, there was the part of like, oh, this is the guy from Goldman Sachs, but it was like something you could sense like this guy felt, it's almost like he realized something seemed off about what he was saying.
Jeff, I just want to push back against something you said, not because I think you're wrong, but I want you to clarify it. You point out that it would be impossible for retail investors to force a squeeze in something like silver and the differences between cornering a commodity versus squeezing a stock. But I remember 10 years ago, there was a moment when GLD, the gold ETF, had more assets in it in dollar terms than the SPY. And I do think that GLD was moving the price of gold. I can imagine a similar situation with silver and the silver ETF if people get excited enough about it, where what happens in the markets ends up influencing what happens with the actual metal in real life. You're saying you don't think that that's a possibility?
I mean, you're talking 900 million ounces in the ETF versus a 25.
I don't know where he comes up with that 900 million ounces. You can see here.
It's all of the ETFs.
1.6 billion is all of the ETFs. SLV has fluctuated between 6 and 700 million. So
right.
I don't agree with that number, but
5 billion ounce market. And by the way,
but those billion ounces don't move.
But he also said that, there's no way the retail traders can squeeze that. I'm not sure that I would agree with that, even if you're being technical about it, but it's not like only retail people can read the internet. And when he says there's no possibility of it, I mean, I guess I'm just curious how he says that. You see the date here is February 4th. And here are the changes that he didn't mention that, I mean, again, Goldman's an authorized participant of the trust. So when SLV and these other trusts change to say to intentionally create a short squeeze, does that seem at least a little disingenuous to answer the question like that and not mention that in the middle of the night? They didn't even tell me about this when I called iShares Direct.
Mm-hmm. Well, what he's talking about is that the ETFs create artificial supply in the market. And I would say parenthetically that that's not legal unless there's some loophole that they're going to stand behind.
Actually, David, can I hop in there for a second? Because apparently it seems like that's exactly what they did. Listen to this whopper. That they slipped in the night before Jeff Curry went on TV and said what he said, to the extent that demand for silver... wait, no, that's not quite the one I was looking for. Hold on a second. There's one in there where they actually talk about how you could have more shorts outstanding than shares that are available. It may be in one of the other articles, but I'll let you comment while I look for the exact clause.
Well, if, as Curry is suggesting, that they are the ETFs are buying and immediately dumping this metal back into the market again, in terms of hedging it, then you could go on forever and not have a squeeze. But the problem is that when you look at Manley's work, is that the obligations on the bars that are available in London are so large now, and the amount that is being acquired is so large that they're running up against limits of where they would not be able to explain where they're getting the metal from. If they were having you believe that they actually buy and secure physical metal, they would have an explanation problem. So I think that's the key issue here, is that if there's around 1 billion ounces in London, there's 150 million ounces left. SLV acquires 110 million ounces in a couple of days. You're now in the realm of where you're going to have an explanation problem of where you're actually getting these bars from. If COMEX isn't moving and London only has so much available, and Curry's point there about the metal that's in the market, he uses 25 billion ounces. That may be the amount that's been mined throughout history. But we know most or much of the silver that's been mined throughout history is now in dumps. We know from the palladium market that when you have these types of supply requirements coming to the market in a short period of time, that you can't necessarily get all the bars that are in the market, number one. And number two, the bars, the metal that you secure in these markets is of a very specific refined bar form in a 1,000 ounce bar. And that's where the constraint is that who's got the silver, who wants to sell it for paper, and then can you get it through a refinery and get it into the hands of those who are obligated to deliver, and then into the hands of those who are buying. And that's something totally different. So I think it's quite fatuous for Curry to say that there's 25 billion ounces and that these numbers aren't large. We know what's in the London vaults, if we're to believe the LBMA and the Bank of England. There's not a whole lot there. There's a couple of days of demand in London vaults, and that is in theory being gobbled up very, very quickly. So it's very material, the amounts that we're seeing moved right now in terms of the silver market and the bar form that's available in the silver market.
Yeah, and David, another point that perhaps you could clarify, I know comes up a lot. It's, there's people who say there's no large short position, it's all conspiracy theory and weirdos on YouTube talking about silly things. But would you say that if they actually added a clause the day after it seems like the market broke, when they added tons of metal while it came down 10%, and then Jeff Curry didn't mention it the day after, but if they added in the prospectus the actual clause, large banks with substantial short exposures to silver, what would you say about that? Would that be perhaps legal evidence that there are large banks with substantial short exposure to silver?
Yeah, I mean, it means what it says, right?
Okay, I guess I was confused. I heard an interview with Jeff Christian last week where he said that was all conspiracy theory. Maybe Jeff didn't read that they added in the prospectus and told no one that there are large banks with substantial short exposures to silver. So I'd say anyone who's new to what's been going on here, but is out researching and just has a genuine intention to find the truth, maybe if someone tells you that, you could look up at that one. So
quick point here is if you look at the SLV ETF prospectus, you've got JP Morgan Chase, or JP Morgan Bank, North America, acting as a custodian. And they themselves, and this goes back to Blythe Masters' video from 2012, they themselves don't have the short position in place. They are just the custodian facilitator. And JP Morgan is the custodian for many of these silver ETFs, and they would be facilitating the ETFs themselves of hedging the silver that they bought back into the market, and they would have intimate knowledge of what's going on in the silver market. So yeah, so these ETFs and banks that are operating these ETFs, Bank of New York Mellon, for instance, with the SLV, is giving direct instructions to JP Morgan Chase, according to the custodian agreement, as to what to do with the silver. So there would be banks with large short positions in the market, if you want to call it that, in terms of shorting out the shareholder-owned silver in the ETFs. So we need a statement from these banks to clarify what Curry said. Have they taken the shareholder silver and obligated into the markets? And that is the question we need to have answered.
Do you
Sorry,
think,
Chris. one point, Chris, can we jump to that chart that I just sent you? Because it feeds directly into this materiality issue.
The one from Craig Hemke?
Yeah, you just scroll to the bottom of the screen and you can pull it up.
Wait a momento. I'm logged in on my Safari browser, but and David, while I pull that up, would you say it's a conflict of interest that JP Morgan shows up as the custodian of all these trusts? And also that JP Morgan, in addition to being the custodian of SLV, is also an authorized participant?
I don't want to characterize it. There's problems with it. I don't want to characterize what JP Morgan is doing. All I want to do is take them at their word and say, at their word, compared to what Jeff Curry is saying, there's a problem. There's a severe problem, and we need to have answers from JP Morgan and find out what exactly is going on.
Well, just based on past history, I know that when Daniel Shack accused them of spoofing the markets, they said they didn't, and then later wrote him a check. So, David, yeah. I know fortunately you're smart enough to double check anything that comes out of the mouth of someone with a track record like that. So yeah. Is this the chart we're looking for?
That is it. And the gray line there that's got the red ellipse around it is showing the ETF holdings of silver. That's the gray blue line, or the steel blue line there. So you can see it goes from, in round numbers, about 525 million in 2019. And then in 2020, it surges from about 600 million to 750 million. During that financial crisis, people are piling into this metal.
Another small move.
Another small move with a decline, a net decline in the price. If you look at that price chart there, the purple line at the bottom is the silver price. And this chart goes to roughly the middle of the year or late summer before the price blew out in the fall last year. It went from, 18 or 1750, whatever this is showing, to 2930. But this is, I think, very interesting in seeing what I would call a material amount of physical demand hitting the market in the ETFs, and the price is declining during this period. And that goes right back into Curry's words again. If the banks, the ETFs, are buying silver for their client shareholders and then turning around and dumping it into the market, there would be no net impact on the silver market. So we need answers, and we need statements from these banks to clarify the situation. And I think that's the very least that we need here.
Yeah, and David, I don't want to overwhelm you because I know this would be a job requiring many pencils, but we probably would need more circles on the graph, because even back in, I've looked at this before, here's your silver price coming down from $50, getting torched for 5 years. And then you're the whole time, maybe a little came out here, but it was already going up quite a lot, even while the price was coming down. So, But probably the CFTC, when they're done investigating the Reddit traders, will be all over that.
Well, if Curry is correct in what he says, maybe you only need to multiply that gray steel blue line or the gray line by, let's say, 20% or 30%, because they're dumping such a material amount of the metal directly back into the market through hedging operations.
David, what if, just throwing a hypothetical out there, I'm like trying to think of some way it makes sense. What if the banks are planning to ask everyone's grandmother for their silverware to fill additional demand? They're going to melt that down into 1,000-ounce bars. Could that work?
Well, how do they ask them?
Well, we'll leave that one aside for now.
The metal that was in silverware hit the markets in the 80s when the price went to $50 back then, which, if you look at a Big Mac index, a Big Mac is 5 times what it was in 1980. That would mean today's price would be $250 an ounce. So if the silverware, from the prior century hadn't hit the market with $250 an ounce, I don't know how it hits the market with price at $30 an ounce. And the banks have no claim on people's silverware.
Well, that does seem to be the case. David, I have one of the articles pulled up here. We've talked about Jeff a bit. We can leave him aside for now. Anything else you wanted to comment on in this one, or that people should see, though?
Well, I think it feeds directly into the next thing, which is Blythe Masters, because it's very, very, very notable what Jeff Curry said.
All right.
It's shockingly offensive in terms of the implications to me.
I think that's a pretty justified statement. And anyway, the link to David's article is in the description field below. So folks, you can read that at home. David, should we hop over to Blythe now? I mean, it sounds like you're ready to share your thoughts. And
this is a beautiful interview. I mean, it's lovely. And I just want everybody to notice here that when she makes a declaratory, definitive negative statement at the end, and she's nodding her head while she's making a negative statement. And I always get a little bit worried when people say something negative and are nodding their heads. There's a little bit of an internal conflict in the message there. So I'll just leave it at that for the video.
All right. Well, you got me excited. So let's start here and
about the prospects for growth in this particular area.
And you're looking at growth not only in agriculture and in metals and in oil, but across the board in all facets. That's what you're investing in. A lot of concern has been placed, though, about JP Morgan's, particularly its positions in the metals space, and looking at your positions in silver. We talked earlier about the volatility in the silver market. Can you talk about JP Morgan's positions and price volatility, and how are they related?
Yeah, that's a great question, and you're right that there's been a tremendous amount of speculation, particularly in the blogosphere, about this topic. And I think the challenge is that speculation represents a misunderstanding as to the nature of our business. As I mentioned earlier, our business is a client-driven business where we execute on behalf of clients.
David, quick pause there. In the confessions from the JP Morgan junior traders that Blythe and her friends left out to roast while she's disappeared, they confirmed exactly how they were screwing their clients on their client desk. So that be noted there.
To achieve their financial and risk management objectives. The challenge is that commentators don't see all of that activity simultaneously. So just to give you a simple example, we store significant amounts of commodities, for example, silver, on behalf of customers. We operate vaults in New York City, in Singapore, and in London. And often when customers have that...
Now, according to Jeff Curry, while they store that, they go out and hammer the price on the COMEX.
Stored in our facilities, they hedge it on a forward basis through JP Morgan, who in turn hedges itself in the commodity markets. If you see only the hedges and our activity in the futures market, but you aren't aware of the underlying client position that we're hedging, then it would suggest inaccurately that we're running a large directional position. In fact, that's not the case at all. We have offsetting positions.
David, she's going down Jeff's path with the hedges again. Do you want to take a stab at because I think this is the type of thing they say, people who aren't experienced, it slips by. She's saying the same thing. I mean, that's what Jeff said too, but it doesn't make any sense to me. Do you have any thought there?
Well, she talks about their clients. We don't know who JP Morgan's clients are, except for one that I know of, is the ETFs. And she says, we store silver for our clients. And we know that JP Morgan Chase stores very, very large amounts of silver for the ETFs. Now, if she's talking about hedging silver held for the ETFs, as Jeff Curry of Goldman Sachs says that they do.
And as their prospectus forbids.
We have a problem here, right? Because Blythe Masters would know that the owners, the beneficial owners of that silver that is held by JP Morgan Chase for the ETFs is not, for instance, Bank of New York Mellon. If they told them to go and dump this into the market and hedge it and create artificial supply, if they said that, then she would know that their clients aren't truly hedging their assets. And that's the question. I would love to sit down and have a coffee with Blythe Masters and ask her just two things. And one of them, go ahead.
Well, I was just saying, would it be even more fun if you had that coffee in a courtroom with a judge and a jury?
Yeah, I can do without courtrooms, but I would love to see it. I would love to see it. And if I was in a courtroom, I'd have very, very short questions to ask. And one would be, what exactly are you hedging here? What risk are you hedging? If you have somebody that is holding metal for somebody else and it's owned by somebody else and you are hedging it into the market, how do you justify that? Because this is the old rehypothecation scheme, if that's the case. You're creating 2 claims or more per single unit asset that you hold for another beneficial owner. It's not a good thing. Let me just leave it at that.
Well, we'll let her continue talking.
We have no stake in whether prices rise or decline. Rather, we're running a flat or a relatively matched
So
book.
it's not.
David comment on them having no stake. I mean, I noticed that even the year they paid a $920 million fine, they still cleared a profit of $1 billion. And you think that's just on collecting commissions on the contracts they're selling, or what do you think of this one?
Well, I don't think her book is flat, because it's actually quite lopsided if what Curry says is correct. It's not a flat book at all, because what you have assets and liabilities, and you have now obligated assets that are not owned by the ones directing you to short it into the market, and you've created 2 claims on those assets. So the book isn't flat. You can say, oh, we hold silver and we've hedged that silver into the market at the direction of XYZ Bank. That's fine. But the bottom line is that the beneficial holder or owner, of that asset hasn't given you that direction, and it creates a problem, and it creates a very unflat book. So apparently silver hedge flat, but it's not the case at all if the silver is owned by an ETF, held by an ETF for other beneficial owners, and that you've gone and hedged that into the market, creating artificial supply and claims on that silver.
David, do you think it's possible that maybe she never read the prospectus of SLV, thought it was a legitimate hedge, and actually the bank doesn't realize they've been short a lot of silver all this time?
I don't think so. I mean, when did she leave JP Morgan Chase? Was it 2014? 2 years after this interview?
I don't remember the exact date that she left, but it sounds about right.
I'd be wanting to leave.
Well, I mean, I'm sure the CFTC is investigating that right now, and their comment will be forthcoming. But let's continue on.
It's because what is commonly out there is that JP Morgan is manipulating the metals market, and from what you're outlining, that
a relatively matched
so
book.
it's not. It's because what is commonly out there is that JP Morgan is manipulating the metals.
Wait, let's David, I'm going to need 1 second here to pull something up, just because, I agree you shouldn't believe everything that you read on the internet. I don't know, maybe we shouldn't really believe the CFTC's site, but here is September 29th of 2020. CFTC orders JP Morgan to pay record $920 million fine, that at least 8 years. And I believe, let's see if the dates are in here, if it was actually the date, 2008 through 2016. Mm-hmm. And would you believe it? This is 2012, which David would mean that it sounds like she just flat out lied here.
Well, she's talking about something different from the trading activity, but there was severe problems apparently from those settlements at JP Morgan. But back it up just about 10 seconds here. Let's just hear what she says there just one more time here. Okay, that's good.
Underlying client position that we're hedging, then it would suggest inaccurately that we're running a large directional position.
Yes.
In fact, that's not the case at all. We have offsetting positions. We have no stake in whether prices rise or decline. Rather, we're running a flat or a relatively matched
So
book.
it's not. It's because what.
So rehypothecating silver, which is held by an ETF for other beneficial shareholders, looks to me like it is a directional bet, because what they would be doing is creating virtual silver and obligating that silver into the market with a second claim on it. And as a consequence, they're adding metal to the market, which doesn't exist in terms of single true owners of the metal. So I don't understand what she's saying here. In terms of what Curry is saying and what she is saying, there seems to be a conflict in terms of what is truly going on with the metal, which is being hedged by JP Morgan into the market here. So it would be great to hear a statement from JP Morgan clarifying this.
Yeah, well, I'll make a note for my lawyer to reach out to Blythe and see if she can help explain that. That would actually be pretty helpful. So why don't we continue on here?
What's commonly out there is that JP Morgan is manipulating the metals market, and from what you're outlining, that is not possible because of the different sides of the business that you're in part of.
That's right. It's not part of our business model. It would be wrong, and we don't do it.
I guess I must have heard that incorrectly, because apparently they do it plenty. David, did you know that involved? I don't know if you can see that.
You notice that she said we don't do it with a head nod.
Well, and they didn't just do it a couple times or 100,000 times. They did.
No, I find it interesting that she nods her head there as she says it.
We'll get it like the Zapruder tape. We'll go see the head nod too.
Morgan is manipulating the metals market, and from what you're
nice that she's giggling while her bank was manipulating the price hundreds of thousands of times. Might add the confessions of the traders that she left out to roast, assuming they were there at her time, or her friends left out to roast, said it was widespread practice. They all said it, every single one of those statements. Widespread practice that was taught to them by their supervisor at the firm. And what did Blythe is laughing about it.
Outlining that is not possible because of the different sides of the business that you're in part of.
That's right. It's not part of our business model. It would be wrong, and we don't do it.
And so, David, before we get your comment on that, maybe if there's anyone watching today or in any of those chat groups that does have experience reading body language and like to look into that, it is kind of weird. I'll play it one more time and then we'll get
manipulating the metals market, and from what you're outlining, that is not possible because of the different sides of the business that you're in part of.
That's right. It's not part of our business model. It would be wrong, and we don't do it.
You've had such a long.
Any other comments on that one, David? Or can we get her off my screen yet?
I think that's good.
All right. I guess a few last notes. Well, maybe we'll leave that aside for today. But going back, we did have another interesting tweet. This one from Bob Coleman. Yeah, I believe this was last night. Yes, the 19th. And today is the 20th. Okay. Plot thickens. Over 5.5 million silver ounces were delivered out of the COMEX registered category this week. These are the bars that back the futures contracts. So I'll pull up. Are you able to see the picture here? And can you help folks understand what that means?
Well, the registered category is metal that's available to market. And what are we seeing there? Is it 545? I can't pull up the lower right-hand corner. Net.
This one?
Yeah.
Actually, let me see if I can zoom in. Sorry. It's 396 is the combined total. 396 million ounces.
Right. So 5 million, my point here is that the COMEX rulebook allows the directors of the COMEX to force cash settlement at any point. And my sense is that they've been doing it for years and years and paying premia to people that'll take extra cash instead of the metal. So Chris, I've heard so many claims that this is the time they're going to break the COMEX, are going to break the COMEX. And there are so many different barriers they can throw up in terms of actually draining the metal out. So, these are the transparent holdings of the various banks, but can you get it? Can you get at it? I don't know. I just try to stay focused on that lease rate in London as a signal, a market price signal, which to my understanding, they haven't been able to fudge it, of stress in the market. And, knowing that the COMEX can do all kinds of things to prevent these vaults from being emptied, I have a lot of difficulty following this closely.
Yeah, that's certainly understandable. Although it looks like we have a comment. I don't know if this is directly from Ronan Manley, but Bullion Star. It says that movement refers to bars being taken off warrant and being reclassified from registered to eligible, not being delivered. Delivery refers to warrants changing ownership. In the
Right.
time period you referred to, there was actually a net 730,000 ounces added.
Yeah, so the eligible is just metal held in the vaults by clients and not available to market. It's the registered which is available to market.
Well, I appreciate that. Something you touched on a little bit was on my question list here. Back to the lease rates. You know, we hear that, yeah, the retail is one thing, and certainly, I don't know, maybe that's where it started this time. But would the lease rates be reflective of when the industrial users start to see some sort of disruption? Or when
Any
does
user.
Apple or Samsung officially get, hey, something's happening here?
They would get it off the lease rate, and it's an indicator of metal shortage. So anybody that is sourcing material amounts of silver bar in the market is going to feel that impact that the lease rate is signaling. It's signaling shortage, and as I said earlier, it may be that a silver buyer doesn't see the offer in size in the market, and they don't want to move the price in a material fashion much higher. And they would look at the market and say, well, there's not an offer here. I can't get enough metal today. So they would turn to a lease as an alternative method of getting metal for a short term. But I just want to point out here that these lease rates can get crazy. And we saw that in 1997 in the palladium market in London. Dresdner Bank, which is the second largest bank in Germany, was on the verge of collapse because of the demands. It was short palladium, and the palladium shortage was the Russians stopped delivering or slowed their delivery for a period of time, and the lease rate shot to a per annum rate of 300%. So it's something you would sit in for a very, very short period of time, where you're absolutely going to get hammered if you're required to deliver into the market or face default. And the penalties of each of these London contracts, we don't know the details because it's an over-the-counter market, but each contract would have its own details in terms of consequences for default.
I mean, it sounds like it's a short squeeze waiting to happen.
Well, I mean, I look at it as, shenanigans waiting to be discovered. I mean, if you've got multiple offers of bars, physical bars into the market, and many claimants as a consequence for each bar, you're just asking for it. If all of a sudden the deplorables show up in the US and say, we're about done with this manipulation and the abuse, and we're buying something that's got a 4,000-year history as money and is a secure asset that's not dependent on these guys who have been hosing us in the system, and we'll take it and goodbye. And then all of a sudden you get 100, 200, 300 million ounces of demand showing up in a year, in addition to the projected demand, which was there previously. And you've got a severe problem on your hands if you're one of these guys who has sold silver several times into the market, and you actually need to deliver bars to any of them. You need to get out of your position at a lower price.
Yeah, and David, in terms of when we would have a canary in the coal mine that becomes unavoidable to the industrial users, so am I understanding correctly? You're saying that has already occurred?
I think we're seeing the onset. Let's see where this goes. A 1% lease rate is not extremely high, but you can see there it's a breakout. So let's see where it goes from here. But I view these deplorables showing up and buying consumer bar form and coin form of silver in the tens, 50s, and hundreds of millions of ounces as an exogenous material event on this market. I don't think they saw it coming. And now you've got guys running around, these bullion bank and metals advisors and all these clever guys running around explaining why this is not important. And I think it's material, and I think it's honest. And I think that we've got these guys now. With Curry's statement couldn't have come at a worse time for these guys, because all of a sudden it focuses a laser beam of attention right on the book, which is vulnerable to this squeeze by the deplorables in the U.S. So I think he was trying to talk it away, and all he did was bring it all down on the ETFs that he's trying to explain away.
David, would you believe me if I told you he actually did a 50-minute podcast about short squeezes, which I now have a saved copy on my phone, and I'm looking forward to going through.
When did he do that?
I'm not sure. It looked pretty recent. I think it must have been in the last couple of weeks. And it just struck me as it just made me think of, like, maybe that's why JP Morgan never says anything, because when you're doing stuff that doesn't add up and you start talking, then people can review what you're saying. So,
you know, what's interesting too is I've listened to a number of these advisors, including Jeffrey Christian and a fellow from Rockefeller Brothers Fund and a number of other guys talking about the silver market and saying, if you're interested, buy a few bars and put it in your safe. Don't buy the ETFs. Now, I'm looking at PSLV, what's happened here. And since the end of January, PSLV is the Sprott Physical Trust in Toronto. And in that short period of time, they've added about, I believe, of the order of about 17 million ounces to their Canadian vaults of silver. And I mean, last week alone, they added over 9 million ounces to their vaults. And if you look at the daily production globally of silver, and in a market, liquidity is the key. And if you look at these markets and consider the fact that the mining supply of silver is the truly liquid supply, if any's going to hit the market, pardon me, it's going to come out of the miners. And you look at the level of demand, the global silver production in total, including the refineries and the recycling, is of the order of about 3.2 million ounces per business day. And so when you have in a week, one fund taking over 9 million ounces out of the market, and that was a 4-day week, you know, you call that not material? Liquidity is everything. And we have no idea how many of these 1,000 ounce bars are available into the market, but it certainly looks material to me. And when one fund in Toronto can move that amount of metal, I think we do have an event here which is building. And then you load up on top of that the deplorables who are buying bars and taking it home. You've got a serious problem in this market if you've rehypothecated material that's not yours into the market.
Well, that's what I thought too, and wrote a book about, but I know that the FTC, JP Morgan, and Goldman seem to see it otherwise. Although, David, I'd like to apologize. Apparently, I cut you off while you were about to say the two questions that you would love to ask Blythe Masters over coffee. So again, let me shut my mouth so we can hear those, please.
Well, one was, who are your clients? And who owns the gold that you're shorting into the market? Who owns the gold?
Yep.
If you have a flat book, right? You have an asset and you have a liability. If your book is flat, net flat in terms of being long and short, who owns that asset that you're shorting into the market?
Good question. And anything else you'd like to ask Blythe, David?
Those are kind of the two things.
All righty.
Any
comments?
I don't want the chat to go crazy.
Yeah, I hear you. Any comments on the recent backwardation we've seen in the futures curve?
Yeah, the COMEX futures curve. I mean, again, it's not the curve I'm that interested in. I'm interested in the London numbers. Yeah, it's flat. It's showing stress. Backwardation is a sign of stress because you're paying more for near-term delivery. There's a cost of storage and insurance over time, which should be reflected in a higher future price. So, you should theoretically be able to extinguish backwardation very quickly if metal is available, because you can sell spot, buy a future for delivery, and pocket guaranteed immediate gain. And if you can't extinguish backwardation, it's a sign of serious shortage. So if it continues and grows, it's another signal of shortage in the market.
All righty. Well, we'll see if Jeff is concerned at all with the backwardation at any point. Two last questions for you that I have. Do you happen to know on this chart here? It's kind of hard to see day by day. Do you know what specific day this popped?
I don't. I can look, but I would guess it would be February 1st, but who knows?
Yeah, that's what I was wondering too, when that occurred, right? I mean, it feels like something significant happened and broke between February 1st and February 3rd, which wouldn't be surprising given that surge of demand that we saw that, has slowed somewhat since then, but not gone away. So perhaps if you can find that out at some point, keep me posted, be interesting. Last one I have for you here. Someone actually wrote in this morning asking, has there ever been a conversion of one of those SLV baskets? Any chance you have any thoughts or know the answer to that?
I know a fund manager who approached JP Morgan, who is an authorized participant in the gold ETF, the GLD. Mm-hmm. And he approached them as a fund manager who is managing other people's money to buy bar for his fund and take delivery through the authorized participant from GLD. And he was politely told to pound sand.
Yeah, that's pretty much what I've heard how that goes. And I mean, it makes sense because it's the same banks that run the COMEX, or the authorized participants of that trust. And it was interesting. Another one of the legal clauses they put in there was that when the demand exceeds supply, seemed like they gave themselves an out about adding or redeeming or creating baskets. So it almost seemed as if they gave themselves leeway to facilitate a short squeeze. I'm not saying that's what they intentionally did, but just as someone who's worked on a trading floor around people who are experts at finding the loopholes in a contract, it sure seemed like that was left open. But
if what Curry says is correct, then the SLV and by extension the GLD, if they're doing the same thing, they would be basically paper shunts. And what they would do is shunt investors into paper, which would have ultimately a highly mitigated impact on the market if the majority or even a large number of the ETFs were buying metal and then pounding the market with it, turning around and hitting the market with it while they were supposed to be holding it. So it would be a fantastic shunt to move investors into what they think is gold without having to have a material impact on the gold market or the silver market.
Well, David, they're that sophisticated. They're traders. They can add 10% of the supply in a day and just work the order so nobody notices. I know I said that was the last one, although would you like to make any comment on BlackRock selling more than 470 million worth of gold as it focuses on silver? Has BlackRock just been studying the gold to silver ratio and they're thinking that's too high? Or why do you think that is being reported at this particular time when there's so many coincidences happening?
I don't know, but if you look at the numbers, they sold 471 million worth of GLD and bought $30 of SLV. So,
835 million.
Sorry?
They sold
471.
I see 835.
Higher, the paragraph above it.
Oh, dollar value of GLD. Okay. Oh, that's what they owned. You're correct, sir. And
so they basically invested 1/15 in round numbers of what they sold into silver. So,
well,
not.
I wonder if they're going to rethink that after Janet goes big next month, but we'll see. And David, any final thoughts? Again, I really appreciate you explaining all this today. A lot going on. Any final thoughts before we wrap up here today, sir?
One quick point. Can we pull up that LinkedIn article I did? The first link that I sent you. I just wanted to, it was
This
commenting. No, the other one.
All right.
Yeah, if we can scroll down there. This article, February 15th, and people can click the link and see it. But what I found interesting about this was that SLV in their prospectus, so this is BlackRock and Bank of New York Mellon in this document. What they were saying was that their structure with the custodian, which is JP Morgan, they didn't say that they guarantee or they're obligated or they have to use best efforts to secure the metal or that there's some kind of penalties. They just said that the agreement contemplates that at the end of each business day that JP Morgan would hold no more than, effectively one bar or 1,100 ounces of the silver in unallocated form. And if you scroll down just a little bit more there, Chris, so I'm saying they're contemplating is not a very strong thing. And then we actually dug up this custodian agreement, and it requires the custodian to take reasonable steps. So again, not a best efforts type of leave no stone unturned and, scrub the markets and alert us if this is not possible or any kind of requirements there. But they say they use reasonable steps to secure it. And if you scroll in a little bit more, the thing that I found very, very interesting was it describes in here that Morgan's going to hold two accounts for SLV. One account is an allocated account, and one is an unallocated account in respect of silver, which you ask us to hold for you on an unallocated basis. So, I mean, I believe the signatories in this agreement were Bank of New York Mellon and JP Morgan. So what this is saying here is that JP Morgan is going to hold silver in an unallocated account as directed by the Bank of New York Mellon for the SLV Silver Trust. So I've never heard of these two accounts. I've never seen them reported that SLV says, here's how much we got in an unallocated account, and here's how much we have in an unallocated account. This is exactly what people have been expressing concerns about for all these years. And we find in their regulatory filings the fact that there's provisions to hold this type of an account. And it would be excellent if SLV would publish, the amounts held in these two accounts for their investor shareholders.
Yeah, I think it'd be great if they published it for the CFTC as well. And David, it's interesting you mentioned that because all the things I discussed previously about my phone call to iShares, I realized a day or two ago, I had a note. She told me it was allocated and unallocated, which I thought was strange. So I appreciate that you went through the prospectus and put this out here. And I don't know, I'm just wondering out loud. I mean, just popped into my mind. But do you think there's any chance that given that JP Morgan was Bernie Madoff's sole banker, that perhaps to save some time, they just reused the original contract and forgot to change some of these things? Or I'm just trying to spitball some ideas.
This is a custodian agreement, right? So I just find it interesting that the custodian agreement with JP Morgan has an allowance for two types of accounts, and that they specifically say, the unallocated account is in respect of silver, which you ask us to hold for you on an unallocated basis. So they're saying at your direction, we'll put however much unallocated promissory note style silver in this account. I've never seen this in the prospectus, or I've never seen this promoted by SLV, that they have this account with their custodian. And it would be great to see two line items reporting the two types of silver that it's possible for the custodian to hold for SLV.
Well, I would love to get some clarity. I did call JP Morgan the other day to see if I could get comment on a few issues. They didn't seem to be particularly excited to hear from me, if you can imagine that. Although, David, actually, I know I've said it many times, but before you go, can I show you something special?
Sure. One note before you do.
Yes.
I would call Bank of New York Mellon, because they're the ones who give instruction to JP Morgan, right? JP Morgan here is the intermediary. The guys who are telling them what to do is the Bank of New York Mellon.
Yeah, well, perhaps that's a great suggestion. I know for all those rascally Reddit traders that are out there viciously exposing the banks that have large short positions on silver, according to the prospectus again, maybe they can call Bank of Mellon, they can call iShares and find out what other whoppers they let slip when they don't realize people actually aren't stupid and are now holding them accountable to the things that they say.
It's a reasonable question for a shareholder to ask.
Yeah, I would say if I was a board of directors of one of these trusts or companies, I'd be asking that too, because David, would you think there's some legal liabilities in there somewhere?
I would think so.
Well, hopefully Jeff Curry will be back on CNBC and we can catch up with him soon. Fortunately, today we had real David Jensen, the great David Jensen. Thank you for digging through all these details, finding the lease rate information. I know you have to actually go into bankerland to some degree to do that. So hopefully you wore, like a sturdy raincoat or something, but can't thank you enough for everything you shared here today. I think it's very crucial that people understand these things at this particular time and you put it in great context. And I thank you for that, sir.
Thank you. My pleasure, Chris.
All right. And folks, we're going to wrap up for now. But with everything going on, we have an all-star studded lineup cast for tomorrow. We're going to be doing a live show half hour before the market opens, broadcast whatever happens if the market opens, even if it gets spoofed or sits there like a rock, we'll be there. And who knows, maybe we'll see some movement. So 5:30 p.m. Eastern tomorrow. It's going to be a cast you'll like. David, thank you again. We'll see you again soon, sir.
My pleasure. Thank you.
And we